What if I told you you can get a house for free, and not only that, your friends can pay you money whilst you live in it? Well, that's exactly what I'm going to be breaking down in today's video. This is going to be of interest to you if either you are a student or you're a parent with one of your kids about to become a student, because you might be able to do the magic thing of helping them get on the housing ladder way before you thought possible. If you don't know what I'm talking about, I am talking about the Buy for Uni mortgage. Now, most people have never heard of this, but you can get up to £400,000 advance, 100% loan to value, which means you don't need to put down a deposit right now at just 4.2% per annum. How does it work? Student and mortgage don't exactly go together too often, do they? You've got most students don't have much financial literacy. No offense, I definitely didn't. Don't have a lot of money, don't have a salary, and frankly don't have much of a credit history as well. So why exactly did the banks think that this would be a good idea, and how can it benefit you? How does this work? Well, first of all, it's on an HMO, which is a house of multiple occupancy, specifically something that is not mandatory license, i.e. this needs to be a 4-bedroom property or less. And the way this is going to work, let's assume you are the student here, but if you're the parent, have a think about this the other way around. You will end up going out and purchasing a property, 100% loan to value, which means you don't need to put down anything in terms of a deposit. And then your parents can either be a guarantor for the 20% by putting a charge against their existing property. This could be a family home or a buy-to-let property, it doesn't matter, for up to 20%, or they can hold 20% of the value money on account with the bank. So they keep it in there, they're still going to earn an interest on it, but the bank's at least got that money that they can earn on that too. What's interesting is they are a guarantor on the mortgage, but they are not on the deed of the property. I'm sorry parents, what that means for you is you accept 100% of the liability or joint liability, but you benefit from none of the uplift. But this is actually really important, and I'll come back to why a bit later in this video. So let's go through the pros, and I think they're pretty obvious, but let me just break it down a little bit. Number one is the fact that you're not going to be wasting money on rent. According to up-to-date analysis from the banks, the average student is spending £518.10 on their monthly rent right now. So not only would you save on that, you're also going to get your friends, up to 3 people, paying you the rent, which can pay down the mortgage, so you're getting an asset. But also you're likely to be making a profit on top of this, probably in the remit of a few £100s a month, which, hey, is definitely going to help towards your uni fees, which, let's face it, means a good bit of drinking money at the end of each month. There's also massive benefits from a tax perspective, and that comes in 2 parts. When you're purchasing property, there's something called stamp duty, and stamp duty is a land tax on the asset that you're buying. And when you're purchasing as an investment property, you usually pay an additional surcharge on that tax. But as a first-time buyer, and with this particular investment, it doesn't count as an investment property, it counts towards your first-time buyer. The great thing is for you as a first-time buyer is you don't pay any stamp duty for any property below the purchase price of £300,000. So even if you do go over that, you're going to pay a reduced rate, but anything under £300,000, no tax whatsoever. The other massive benefit is from a capital gains perspective. When you own an investment property, if it goes up significantly in value and then you sell it, whatever that increased in profit that you've made, you would pay a capital gains tax on that. But again, as this would come under a personal residence, not an investment property, you won't have any capital gains tax whatsoever to pay. Even if the property goes from 300,000 to 600,000, which would be insane, on that 300,000, you won't pay any tax whatsoever. So as you may expect with anything like this, there are some downsides. The first one is that you must be in uni for at least a year whilst you're applying to this. So if you're in your final year, I'm sorry, this won't apply to you, but if you're about to start uni or in your first or second year, Great news. A pro to that is the fact that you can apply any time within that first 2 years, if you like, but you must have a minimum of 1 year remaining. Number two downside is the fact that you need this guarantor in place, and the way that this is structured in particular is the fact that your parent, your mum, your dad, or whoever your guardian is, will factor in the full liability or joint liability with you, but won't have any upside. Now, I guess from your perspective, that doesn't really matter, but maybe you're going to have to do some convincing for your mum and dad to do this, because the likeliness is they are going to be assuming some element of risk on perhaps their family home or a couple of their investment properties. So what's the criteria that these lenders are looking for? Number one, it must be within a 10-mile radius of the property. The closer to the university, the better. Number two is that there is a massive preference for houses, which I guess for a property that size, most of them will be houses. Just bear that in mind, and if you've watched the channel, I'm pretty against flats in general. Number three is that they are going to be on only non-mandatory HMO properties. What that means is you can't go for licensed 5-bed, 6-bed, 7-bed HMOs, which would be making you loads more money. You are restricted from 2 to 4 lettable rooms, including you, which means it can be a maximum of 4 people. The reason that's a downside is it does reduce your opportunity to make money. The next one is, and you need to be careful of this, and this is the fact that they are on discounted mortgages, which a lot of people forget about. If you don't know what discounted mortgage is, this is a preferential rate early on in the mortgage. So what you're going to get up front is a preferential rate, 4.7%, whatever it is that you're getting from the lender, and then after the first year, it is going to end up going up. So just make sure you're on that. The final thing with this as well is there's no fixed rate mortgages. What this means is you are going to be on a variable, which is very rare in the property world, because normally on residential and buy-to-let commercial, you are allowed a fixed rate. Now, it's not that big of a deal because we are at all-time lows, and it's very hard to see how it's suddenly going to spike up in the next couple of years. But it's definitely something to factor in, because if we are at these all-time lows, there's only one way that these interest rates really can go. So just be careful with the risk associated with that. Final things to be thinking about on this, just to be cautious of, is number one, the running costs. The idea of owning a property investment is really cool, but if you're a student, you may have great knowledge in theory, but the practice of actually owning an investment property, don't be naive going into that. You know, when you are renting a property and the pipes burst or the boiler goes, you can give the letting agent or a landlord a call. When you own it, you are responsible for that. And I think there's an added complexity to factor in when you're living in the property with your mates and you're their landlord. Some people would take the mick out of that. You need to have a clear divide between you as the landlord and you as their mate. And also you need to factor that in, because they are your customers as well. The final thing that you want to be cautious of is what happens when you leave university. Now, what you need to be very careful of, this is a really unique lending platform, okay? Once you are no longer a student, you cannot be on a buy for uni mortgage. There are 3 outcomes. Number one, you sell the property. Obviously, they will factor in that, so they will allow you some time to get it sold, and you can monetize on that and hopefully make some profit. Number two is you can carry on living in the property, which a lot of people choose to do after uni, staying in the university town, but you will need to remortgage that onto a residential mortgage. At the current time of filming this, you can do that with as little as a 5% deposit. If you're start of uni, 3 years, I'd suggest that you probably have that equity. But if not, you need to factor in that you're going to need to put in 5%. Or, of course, you could decide to change it to a buy-to-let mortgage. Again, something to factor in is that is currently a 75% loan to value, which means from somewhere, probably a mixture of savings, mum and dad helping out, stuff that money that you've earned, and of course the capital growth. But you are going to need to find a 25% deposit within that time frame for you to successfully hold that investment property. This video may not be relevant for quite a lot of you watching, but if you're a student or a parent of a student, what I want to know is, are you going to take advantage of this opportunity? Yes or no, and why? Let me know in the comments. Or have you started taking advantage of this already? Because it would be great to actually hear from people that have got that practical experience. Let me know either way in the comments. I'll try to reply to every single one. Hopefully you got massive value from this video. If you did, it helps me an immense amount if you just smash the like button. And if you're new to the channel and you want to learn about growing a successful property investment portfolio, then this is a channel for you. Do me a favor, make sure to hit the subscribe button and the notification bell, and I of course will see you in the next video.